The hearing will come to order. I apologize for being late. I had a problem this morning picking up my cleaning. And when I complained, the cleaner told me that it was Congress's fault because they couldn't get good workers. So I apologize. And I'm looking for a new cleaner. This is a very important hearing, and I am very appreciative of all the work that has gone into it. And I want to thank all of the witnesses. Every one of the witnesses today has either in person or through his or her organization been a very constructive participant in this discussion about what to do. And I want to say this. We have, I think, a very important piece of legislation. And I believe that it is important for us, before we adjourn, and the good news for people who worry about hasty legislation, not necessarily good news for everybody's family, is that the majority leader was just announced that we will be meeting on the 4th, 5th, and 6th of December, and the 11th, 12th, and 13th of December. So we have some time, and we're going to be putting back some of the markup on this. And I want to say two things. I think it is very, don't look at me, Gresham, it's the majority leader. I am very much convinced that we will pass a bill out of the House that is very much like what's been introduced. I am also convinced that it will not be exactly what has been introduced. This is not an area where dogmatic certainty behooves anybody. We are dealing with some new phenomena. We are dealing with a relatively new financial phenomenon, and that's really what I want to talk about substantively. I want to really just set here the conceptual framework. We have seen in the past 10 years or so, maybe more, great change in the way mortgages are originated. Innovation in the financial sector is, of course, very important. And we should be clear, innovation does not lead to deeply rooted new practices unless it's of value. There are innovations that wither and die because they don't serve a real function. What we have in the mortgage area are a set of innovations, basically origination by people outside the banking system, by brokers not working for banks, accessing pools of money that are not subject to deposit insurance, and we then have the phenomenon of the secondary market. I want to be very clear, I regard both of those as very good things. These are positive and beneficial additions to our ability to finance housing. The problem is not with innovation, because I think there's a self-correcting thing. If the innovation doesn't serve a positive function, it does not survive in our market economy. The problem is that there is an inevitable tendency for innovation to outstrip regulation. That's why they call it innovation. And our job is to have a regulatory framework that keeps up with the innovation in a way that allows the benefit and the value of the innovations to flourish while providing the safeguards against abuses that it's the job of regulation to do. I believe that we have seen much more of a problematic level of activity in the unregulated than in the regulated sector of mortgage origination. It is not because the people doing the origination in the unregulated sector are morally inferior to those in the regulated sector. I think that morally most people are good, and there are some people who are abusive. The problem is that we have in place, with regard to banks and credit unions, a set of regulations enforced reasonably by regulators which hold in check some of the abusive practices, and we don't have that in the unregulated sector. And so the first part of our job is to extend, in general, the kind of regulation that has served us well, in my judgment, in the regulated sector to the unregulated sector. And that means you allow the process to flourish, but you try to prevent abuses. The other area that we deal with here is the secondary market. The secondary market has been very important. It has clearly provided increased liquidity, and that means more money for people to buy homes and live in their homes. But as with any other phenomenon, it has a potential for abuse. And in particular, and I quote Ben Bernanke here, what he calls the originate to distribute model provides increased liquidity, but it also diminishes responsibility. The regulatory framework provided responsibility. Banks that lent money to people when they shouldn't have lent money to people got visited by the representatives of some of the people at the table who said that really was not such a good idea, don't do it again. And in effect, what we're trying to do is to replicate that in the other area. But you also have in the secondary market the problem that the lack of responsibility that could exist at the origination level could then be passed along. And I know there are people who have said that if we do anything to the secondary market in any way to increase any kind of regulation, we will destroy it. The notion that even a reasonable and mild form of regulation is somehow fatal to any kind of market activity is a frequent argument. As I said before, people who want to read it and experience it at its fullest should go back to the congressional record of the 1930s and read about the debates about the establishment of the Securities and Exchange Commission, when the country was told that that sort of regulation would kill the market. Indeed, we are now in a situation in which one of the problems in the market is a lack of investor confidence. We have had an overreaction here. People went from being too sanguine about some of this paper to being much too negative about it. I believe that rules that give the investor some better assurance that what they are being offered has a certain quality to it, that's market enhancing, not market destroying. And if we do it right, we can help restore investor confidence. And that obviously is a very important issue. So we have a form of increased responsibility, not on the ultimate investor, but on the securitizer, the people who actively package and sell this, because those are people whom we believe can be charged with some additional duty to make sure that what they are selling is material that should have been done in the first place. And I was pleased to see that Chairman Bernanke has agreed that some of this is done. Now, I understand there are people who say we should do nothing. We should be very clear. We are now in the most serious financial crisis the world has seen since the late 90s. I believe it will be one that we will surmount. I don't see terrible disaster looming, but we are in a serious crisis. It is inconceivable to me that we, the Congress, and the regulators working together would do nothing to diminish the likelihood of a repetition of some of these abuses. The innovations in the mortgage market have produced a lot of new homeowners. That has also led to a degree of financial crisis far beyond what anybody expected. And I think there was, I didn't see a lot of people predicting that the subprime crisis was going to spill over into the mortgage market in general, that jumbo mortgages would be in trouble. I didn't see many people predicting that the mortgage crisis was going to spill over into the financial market at large. I know there are people who now say that they knew this was coming all along. I am waiting for the emails in which they made that statement, dated some time ago. Apparently all those emails were purged because, a lot of people now tell me they saw it coming. I don't remember anybody telling me they saw it coming when it was coming. And I think that very fact that we were taken by surprise, all of us, to the extent that we were, is one argument for doing some things and putting some things in place that have to be done. So I guess to summarize, I believe that, and I am very grateful, we've had a very participatory process. We will be marking this bill up probably in a couple of weeks. It's an intensive period, but it's, I think, a high priority for members. I do expect, as I said, that the basic outline will be preserved, but we have some specifics where people will be discussing things. There are additions. The chairman of the Capital Markets Subcommittee has some very important additions that he's proposed. There are some proposals that were made in the testimony that seem to me very important. There are aspects of the bill introduced by the ranking member that are important, and I should say that 2 years ago, this time, the ranking member and I and my two colleagues from North Carolina were trying very hard to work out a bill. I wish we'd been allowed to go ahead. We might have avoided some problems. But I think there is on the both sides here a recognition of a problem. There will be some differences about how to resolve the problem, but there is and has been for some time a common recognition of a problem and the need to try to preserve a flow of mortgages while diminishing abuses. That's the job of this committee. And I'll now recognize the ranking member. We're going to, because of the importance of this, take the full 20 minutes on each side for opening statements. So there will be 20 minutes of opening statements on each side. I plan to be here all day. I've cleared my calendar. It's a long day of hearings, but it is very important that we do all this, and other members will be free to come and go. The staffs will be here. I believe this is a hearing which will have a major impact on what we do. Gentleman from Alabama.